One day, the gold chart is calm. It's slow, almost boring. The price moves smoothly, analysts all seem to agree on the direction, and traders feel confident. Then, suddenly, without any warning, everything changes. Gold spikes violently. Silver crashes and recovers in minutes. Copper breaks through levels that held firm for weeks. All your favorite indicators stop working. Panic spreads across trading floors, and social media fills with confusion. Some traders lose weeks of profit in just a few hours. Others just freeze, staring at their screens, unable to act. And everyone is asking the same question: why? Why do metals become so unpredictable for just a few days? Is it manipulation? Is it some secret news? Is it just random chaos? Or is it something deeper that most people never see? The truth is, these wild swings in the metals market are not random, and these chaotic days are not accidents. It happens because metals are emotional assets. They are not like stocks or crypto. Metals represent something primal: fear, trust, anxiety about inflation, and the instinct for survival. So, when global confidence in money weakens, or when geopolitics feels unstable, metals react instantly. And here's the key: emotions never move in straight, predictable lines. They compress quietly, building up pressure under the surface, and then they release suddenly, all at once. This is why metals can stay deceptively calm for long periods, and then explode when fear changes its shape or intensity. This extreme unpredictability almost never lasts long. Why? Because markets hate confusion. They crave certainty. When new, powerful information enters the system, like unexpected inflation data, a surprise statement from a central bank, or a geopolitical shock, traders, institutions, and algorithms all try to interpret it at the same time. This creates aggressive, violent moves in multiple directions as everyone scrambles to find the new truth. The market is essentially arguing with itself, testing highs and lows, until it finally chooses a narrative. Once that narrative is chosen, a clear direction returns, and the chaos subsides. The U.S. dollar plays a major role in this drama. Most metals are priced in dollars, so you'd think their relationship is simple, but it's not. Metals don't just react to the dollar's movement. They react to why the dollar is moving. If the dollar strengthens because of global fear, a flight to safety, then fear-driven assets like gold often rise right alongside it. But if the dollar strengthens because of economic confidence and higher interest rates, metals tend to fall. During those chaotic transition periods, the reason for the dollar's move isn't clear, and this ambiguity creates short, sharp bursts of chaos in the metals market as traders fight over the narrative. Central banks are masters at amplifying this confusion. They speak in vague, carefully chosen language, where a single phrase can shift multi-billion-dollar expectations. Metals, especially gold, act as a form of insurance against bad monetary policy. So when a central banker's messaging is unclear, the market is forced to price in multiple possible futures at the same time. Will they raise rates? Will they print more money? Will they tolerate inflation? Until there's clarity, the price of gold has to account for all possibilities at once, leading to whipsaw volatility. Then you have interest rates and bond yields. This adds another complex layer. Metals don't pay you interest. Holding gold doesn't generate a yield. This makes them highly sensitive to moves in government bond yields. When yields rise, holding a non-yielding asset like gold becomes less attractive. But what happens when yields swing wildly without a clear explanation? The market gets confused. One side argues that metals should act as a hedge against the inflation that is causing yields to rise. The other side argues that higher yields make metals a bad investment. This fundamental disagreement is a recipe for volatility, triggering sharp price swings until one side wins the argument. And let's not forget raw fear. Events like wars, sanctions, energy crises, banking failures, and political instability cause metals to overreact first and think later. In these moments, fear is the only driver. The market shoots up on pure survival instinct. Logic only returns once the initial shock wears off and institutions begin to reassess the actual long-term impact and duration of the crisis. This is why you see massive spikes followed by sharp corrections. Fear burns hot and fast, but it doesn't last. This confusion creates a perfect hunting ground for large institutions. They take advantage of the uncertainty. They hunt for liquidity, triggering stop losses on both sides of the market. They create fake breakouts to trap retail traders and engineer sharp reversals to quietly build their large positions while everyone else is panicking. High-frequency trading algorithms amplify this volatility. They are programmed to react instantly to headlines and technical thresholds, exaggerating the moves until their programmed objectives are met. And then, just as quickly as they turned on, they shut off, leaving the market to find its footing. On top of all this, remember that metals are physical commodities. They have real-world supply and demand, and surprises here can add to the chaos. A major mine can suddenly close. A critical shipping route can be disrupted. Energy costs for production can spike overnight. A country might restrict its exports. Unlike a digital asset, these physical disruptions force prices to adjust violently and immediately to a new reality of scarcity or surplus. The market has to reprice the physical reality before balance can be restored. So why do most people lose money during these chaotic days? It's simple. They overtrade. They chase the volatility, buying at the top of a spike and selling at the bottom of a crash. They let their emotions, fear and greed, override their discipline. Professionals, on the other hand, do the opposite. They often reduce their position size. They wait patiently on the sidelines, or they do nothing at all. They understand that these chaotic phases are designed to transfer money from the impatient traders to the patient ones. Ultimately, the unpredictability always ends. Markets cannot stay confused forever. Eventually, the new data is absorbed. The large institutional positions are built. The raw, unfocused fear becomes a clear, focused narrative. Trends return, and metals start respecting technical levels again. The storm passes. So, you see, metals are not broken. They are not arbitrarily manipulated, and they are not random. They are honest, brutal reflections of moments when the world itself is recalibrating its relationship with money, power, and fear. These volatile periods exist to punish impatience and reward discipline. Once you understand that this chaos is temporary and serves a purpose, you stop fearing it. You stop chasing it. You learn to observe it calmly. And you realize that in the metals market, calm is not weakness, it is power. If this changed the way you see the metals market, hit that like button, subscribe for more insights, and comment calm down below. Because calm minds survive the chaos, and in the long run, only the survivors profit. Thanks for watching.